May 6, 2010. The New York Stock Exchange. A typical morning, or so it seemed. The familiar buzz of traders, the flicker of screens, a symphony of numbers and algorithms moving at the speed of light. Thousands of trades are executed every second, a complex digital dance where fortunes are made and lost. For most people, it was just another day in the world of high finance. But in a single, fleeting moment, everything was about to change. An event was about to unfold that would be forever known as the flash crash, a moment that shook the very foundations of the global financial system. It all started with one person, one order, one mistake. A large institutional investor intended to sell a block of futures contracts. But instead of entering the order in millions, they entered it in billions. A single, catastrophic typo. In the old days, a human trader might have caught it, raised an eyebrow, and made a call. But this was the age of high-frequency trading. The system didn't verify the order's colossal size. It didn't pause. It just began to execute. Instantly. Imagine a single, heavy domino tipping over. That's what happened next. The system started to sell, and sell, and sell. Other trading algorithms, programmed to react to market movements, saw the sudden price drop. Their logic was simple. If a price is falling this fast, sell everything. They didn't know it was a mistake. They just followed their programming. Stock prices began to plummet at a terrifying speed. The exchange floor, once a scene of controlled chaos, descended into pure pandemonium. On the trading floor, veterans who had seen it all stared at their screens in disbelief. Blue-chip stocks, pillars of the American economy, were showing losses of 10, 20, even 30% within minutes. People scrambled, trying to manually halt the automated selling, but it was like trying to stop a tidal wave with a bucket. The systems were designed for speed and autonomy, and now that very design was driving the market off a cliff. Panic wasn't just on the screens, it was in the air. Phones rang off the hook. Managers shouted orders that were instantly drowned out by the noise. Hearts raced faster than the algorithms that were wreaking havoc. It felt like the entire financial world was spiraling out of control, a runaway train with no one at the helm. Within minutes, the paper losses mounted into the hundreds of billions of dollars. This wasn't just numbers on a screen. This was the life savings of ordinary people, the value of pension funds, the stability of companies that employed millions. Giants of industry were collapsing right before their eyes. The contagion spread with digital speed. Panic leaped from the New York Stock Exchange to every major exchange in the United States. And the world was watching. Global markets reacted instantly to the chaos in New York. Automated trading systems in London, Frankfurt, and Tokyo, connected to the same global data stream, also began to sell. A single error, a tiny signal originating from one keyboard, had morphed into a worldwide financial crisis. The world was witnessing, in real time, just how fragile our hyperconnected, digital financial system truly was. It was a brutal wake-up call. In the immediate aftermath, regulators launched a massive investigation. What they found was a gaping hole in the armor of modern finance. The exchange's algorithms lacked basic, common-sense error checks. There were no circuit breakers robust enough to handle an event of this magnitude. The system was built to allow massive sell-offs to happen instantly, without any human intervention or oversight. It was a colossal vulnerability, hidden in plain sight. The so-called moment zero of this story wasn't the crash itself. It was the single minute, the single keystroke, when that one incorrect order was entered. That was the spark. It triggered a chain reaction that had the potential to wipe out trillions of dollars in wealth and plunge the world into another Great Depression. Humanity, quite literally, stood at the brink of a financial abyss and narrowly avoided falling in. This tiny action proved a profound point. No matter how sophisticated our systems become, they still rely on human judgment. Digital algorithms might operate at the speed of thought, but a single human mistake can have consequences for millions. One decision, 1 minute, and the entire financial world can shake. This was a lesson the market could not afford to ignore. And the changes came swiftly. Trading rules were completely overhauled. New speed limits were placed on how quickly orders could be executed. Circuit breakers were redesigned to pause trading automatically during extreme volatility. Traders and programmers had to undergo new training, learning the hard lessons of that day. The financial world had received a painful but vital education. The events of May 6, 2010, changed the philosophy of trading forever. A system of double checks and verifications for large orders became standard practice. Algorithms were updated with new limitations and safety protocols. Regulators implemented additional layers of control, ensuring that they had the power to intervene. Investors, both large and small, were forced to recognize the critical importance of human oversight. The dream of a fully autonomous, perfectly efficient market died that day. It was replaced by the sober realization that even the most advanced high-speed systems require human supervision. The memory of that afternoon became a permanent warning. One moment of carelessness, one misplaced B for billion instead of M for million, could have brought the global market to its knees. Some companies barely recovered from the short-lived but devastating crash. Markets worldwide froze as everyone tried to make sense of what had just happened. The news shot through financial channels, stunning investors with the sheer velocity of the collapse. Even the largest banks were forced to review their internal risk protocols, realizing they were not immune. What prevented the total catastrophe? In the end, it was the calm judgment and swift action of a few key people who managed to diagnose the problem and halt the slide. They manually paused trading on certain stocks, breaking the feedback loop and giving the market a chance to breathe. That moment, when human intervention stopped the algorithmic madness, was the real moment zero, the small action that saved the global economy. The exchange system was changed forever. All algorithms were retrofitted with additional safety checks. From that day forward, any extreme market scenario would require a human in the loop. Digital systems could no longer be allowed to act with complete autonomy. The lesson was clear. A single key press can have consequences for billions of people. Even in our hypermodern world, there is a terrifyingly thin line between order and chaos. That day in May remains a stark symbol of this danger. Today, exchanges around the world remember the flash crash. Regulators, banks, and investors have learned to value every second and to question every anomaly. Every large trade is now scrutinized and verified. Technology is no longer a master, but a tool supervised by human eyes and human wisdom. Moment zero proved that even in a world of artificial intelligence and instant data, the fate of our civilization still rests on human decisions, human fallibility, and ultimately, human responsibility. A small action, a single minute, could have made the financial world vanish. But it didn't. Human judgment prevailed, and the lesson from that day will echo through financial history forever. Thanks for watching. If you found this story as fascinating as I did, make sure to like this video and subscribe to the channel for more deep dives into the moments that changed our world. See you next time.